Yo, what's up, guys? It's your boy Looney, and today I want to break down covered calls, what they are, how they work, and why they can be a great tool when the market is moving sideways or slightly down like it is right now. Then I'll share exactly what I'm doing with my own positions, including rolling covered calls that are in the money, getting assigned, and how I'm managing those trades. But before we get into this video, quick shout out to the Discord. It is free to join. And then I also offer a premium membership, $8 a month. And that gives you access to one-on-one coaching, trade callouts. I have an option selling course, giveaways, and more. You can check it out. All the links to that are in the description. But let's go over what a covered call is. And let's pull up a stock and actually read about it, because you could actually learn about it on Robinhood itself when you go into the trade options icon in any stock. And once you do that, you could see, scroll down here, it's a single leg and it's a bullish strategy. And it's one of the simplest option selling strategies out there. And you can read about it here on the question mark, and it goes over how it works. But essentially is you sell a call option against the stock you already own. So against the shares you own. So if you own 100 shares, you can sell a covered call. If you don't have 100 shares, you can't sell the covered call. And for doing this sort of trade, which we'll get into, you get paid. You get paid what is called a premium. Let's just use the 12th as an example, because it's about a month out, and that's kind of ideally where you want to be. So if the stock stays below your strike price, which is this number on the left, then you get to keep that premium. And that premium is actually the numbers on the right. I have it set to sell call, and that's how covered calls work. It is a sell call. And the number on the right is the premium. The number on the left is the strike. If the stock on expiration, which is on Fridays at 4 p.m. usually, if it stays above it, you get that premium back and you can do this trade again. But if it goes below that strike price, you'll be forced to sell your shares at that strike price you chose. And I'll get into an example of one that I did, and I actually am forced to sell it, which is not actually a bad thing. So that's why covered calls work great in sideways or slightly bearish, and also slightly bullish as well. But we're in a bearish scenario right now, or at least for the time being. And you can make money from just time decay or waiting over time and volatility, and not just hoping the stock moves higher. So like I said, let's get into some examples of what I'm doing right now. Since the market is kind of choppy or slightly bearish, I'm not making huge new highs, which is perfect for selling covered calls. So the issue is these stocks were running hot, and now my covered calls are in the money. And in the money, all that means is that the stock is trading above your strike price. And like I mentioned before, is I risk assignment. So what does that mean? Is that bad? Is that good? That's not that bad of a scenario. So if we look at this, let's look at the $11 call. So right now, this one is sitting at $11 is my strike price. And if I wait till expiration, I'll be forced to sell my shares at $11. But if I roll it, I can essentially keep my shares and collect more premium, or possibly pay a little. It all depends on where the stock is. If Riot's at $20, then you will have to pay. But Riot's really close to that $11 mark. So it should be either a cheap pay, or I'll get paid very little. But if you go to trade and then roll option, you could hit select new position. And then I like to go 30 days out. So we go about 30 days out. And then you want to go out of the money, or I like to go a couple strike prices above, so that I can actually let the stock appreciate, but also not go too high where it's not even worth it at that point. So if we go to this $12 one, I will get paid $4. So rolling is an advanced strategy, and I'm doing it now with my covered calls. But if you were to do a covered call setup on this stock, let's actually get into what I would do if I were to first start the stock. Because right now, Riot is trading slightly high. But if we look at the 1 month Bollinger Band, it's sort of in the middle. And I use Bollinger Bands all the time. It's not the most important thing you need to be looking at. And ideally, you want to have the stock be trading close to that higher Bollinger Band. But again, not super important. But if you go to trade options, and we'll go back to that 30-day expiration, which is this 12th or a little less, and you want to do out of the money. And again, out of the money is ones that are above the stock price, because you don't want the stock to be above your strike. And ideally, you want to be choosing lower deltas. So anywhere from 0.2 to 0.3 is a great sweet spot. And delta is important because if you go too low of a delta, you don't collect enough premium. And if you go too high, it's sort of a risky play and you face assignment, which you'll be forced to sell your shares, which we'll get into later on in this video. But let's choose this $14 call because this one's a safe one and it's a flat number. So if we go here and then hit sell, we can see here that my max profit is $23. My break even is $14.23 and my max loss is unlimited. So let's go one by one and sort of explain how this works. So max profit is at $23. This $23 is actually the premium and I get paid this in my account right away. The issue is you need time to work in your favor to actually realize this gain. Because if you open this trade, you get paid that $23. But if you close it that same day, you'll end up paying $23 or a little bit more, somewhere around there, and you won't actually realize a gain by doing that. So you need time to actually work in your favor with doing this strategy. Now, number two is that break even, and this is just the premium plus the strike price, meaning that if the stock goes above 14.23, you will be losing money. And we'll get into that because you're not really losing money, you're really just losing the opportunity. And that's this next part, max loss is unlimited. And that's not necessarily true. It's saying that the stock can go up to 100 and your loss will be unlimited. That's not really true. It's really your opportunity cost because you'll still be forced to sell it at $14. The only way to have unlimited loss is if the stock goes to zero, which is very unlikely. So when they say max loss unlimited, that's not necessarily true. It's only showing a naked call. Because you own the shares, it's actually a hedge against each other. So if the stock goes up to here, you'll be forced to sell it at 14, which is actually not a bad thing. So this is a great trade that I would do. And let's go over one that looks like it would be unlimited loss. And that's my Sony position because there are a risk with covered calls. And the risk, let me actually pull it up before I disclose. The risk isn't really losing money. The only way you could lose money with covered calls is if the stock drops significantly, like I just disclosed. But with this one, the Sony one, I put a covered call at $27.50. So really, I'm just missing out. So now because it expired today, Friday at 4 p.m., I'm forced to sell these shares. It usually comes up on the Saturday, the day after is when you actually see that disappear. So you'll see that my shares will be gone. I sold them for $27.50, but I actually made a profit because you can see my average cost is $23.65. So I made around $400, somewhere around there, and I got paid that premium. So another $10, I believe, was that premium. And you can see I didn't lose money. The only thing is that I missed out on about $100 or a little bit less than $100 because you can see my total return now is $500. But if I sell it for $27.50, my total return is probably around $400 plus that premium. Now, there is a risk overall with covered calls in general with assignment is if the market turns around. So covered calls are a bullish strategy, but if you go too high with the delta, there is a high possibility that you get assignment and they go in the money. And that's why you want to be very cautious choosing the right strike price and choose when the stock is a little overbought. But once the market starts turning around and start ripping higher, you sort of miss out on that opportunity of just simply holding the shares of a stock. That's why I'm very selective with what deltas I choose, and I'm constantly rolling so I could actually get that appreciation as the stock moves upwards. And that's why I don't always sell covered calls every day, all the time. I use them on stocks that I am confident with my strike prices or I think will trade slightly sideways. So to wrap things up, right now I am rolling my covered calls that are in the money. And number two is I'm redeploying this cash from my Sony assignment. I'm gonna have $2,750 that go back into my buying power and perhaps use it for another trade. And lastly is I am staying patient for more sideways action to keep that selling premium. Covered calls are a great way to turn your shares into income, and you have to manage them, especially if the market flips bullish fast. Hope you guys enjoyed this video. If you did, please leave a like. Until next time,